All right, so in this video, we're going to talk about the basics of the mortgage process, okay? What you guys need to know when it comes to mortgages. All right, first off, let's define what a mortgage is, okay? It's a secured property loan between a mortgage lender, which can be a bank or a mortgage company, and the home buyer, all right? The loan helps the buyer finance the purchase of a new home, okay? New to the buyer, of course. It could be a brand new home as well that was just recently constructed, or to refinance a home that was already had a mortgage. Okay, I have a mortgage currently. If I decide, the rates are lower right now, I can get a better monthly payment, then I can refinance and I would create a second mortgage. Okay, all right. The lender has the legal rights to the house because it's a secured loan. So if the buyer fails to meet the terms of the mortgage, then they can take over the house and sell it to make themselves whole. Okay. All right, who needs a mortgage? Most people need a mortgage, okay? Because most people can't afford to pay cash for the house they want to buy, okay? So the vast majority of people are going to need a mortgage when it comes to purchasing a house, all right? Some people will mortgage properties they can afford, okay, in order to use that cash in other investment opportunities, okay? So if you were to pay cash for that house, all your money's tied up into that house. And if you want to invest in other places, a mortgage could be beneficial for you. All right. The individuals are going to need a reliable income, solid finances. Usually debt to income ratio is one of those numbers that lenders are going to look at, and a solid credit score to qualify for a mortgage. Okay. How do they work? The home buyer receives the money to buy the house from the lender, assuming they qualify. Okay. Home buyers are required to make a down payment. Okay, usually the threshold's around 20%. Okay, if you pay less than 20%, there's some other things that are going to have to happen to help the lender feel confident in making the mortgage. Okay, but will be better for you to save up 20% at least to make the down payment. You can always pay more, okay, but 20% is a threshold that you want to be able to meet in most circumstances. Okay, whatever the remaining amount is, that's the amount that's going to be financed by the lender. Okay, the bank determines an interest rate based on market rates and your profile as a borrower. Okay, the term is usually going to be 30 years. Okay, because it's a mortgage, because we're talking about a huge purchase, the term is longer than a car loan, for example. Okay, you can do 15 years, you can do 20 years. If you can afford it, you can do less. But most people start out with 30-year mortgages, and then later on they might refinance to get it down to a shorter period of time. Okay. Terminology, things you need to know. This is going to be a couple slides. Down payment, we've already talked about that. If you pay 20% or more, you do not have to pay what's called private mortgage insurance, okay? If your down payment's less than that, that's another cost that's going to be associated with your mortgage, okay? PMI is what it's short for, okay? You're considered a slightly riskier borrower if you can't afford that 20% down payment. So that's where the bank will help them feel more confident by charging you that PMI. Okay. Amortization, we've talked about that with car loans, so hopefully you're comfortable with that term. Mortgages are amortized just like car loans are. They're just for a much longer term. Okay. Like we did with the car amortization, you can use the mortgage calculators to determine what the monthly payment's going to be, the breakdown of the principal and the interest, and how it changes over time. Okay. Escrow, this is a big one. Most people will pay into what's called an escrow account with their mortgage payment. Lenders offer this to you. You can choose whether or not you want to pay into your escrow account, okay? The escrow basically covers the property taxes, okay, and the home insurance, all right? So that's what is going to go into that escrow account. If you choose to pay your mortgage payment with that included, it's obviously going to be a bigger payment, but what happens is you guarantee that those payments are going to be made, okay? If you don't pay into an escrow account, that property tax, that home insurance, you've got to pay for that out of pocket when it's due, okay? As you pay into that account, the bank or the mortgage company will make those payments when they're due to be made, and that way you don't have to worry about it, okay? Going back to the down payment, if you don't make a down payment of 20% or more, then escrow is going to be required. if you make the 20% down payment, it's going to be your choice, okay? I always recommend, though, pay into the escrow account. That way you don't have to worry about saving the money, and you don't have to worry about making the payments on time. Right? Interest rates, those are based on the market. Right now, at the beginning of 2022, the rates are pretty low, but they've started to creep back up. Okay, your credit profile will be a big part of what interest rates you get, and interest rates can be fixed or adjustable. In most cases, I would suggest getting a fixed rate. All right, the payment principal. Okay, after the car loans, we already know quite a bit about principal and interest here. So the principal is the amount borrowed, okay, after you've already made your down payment, okay? The down payment has already been paid. It will not be part of your mortgage, okay? It starts lower at the beginning of loans and increases over time based on the amortization schedule, just like we talked about with car loans. Interest starts at the highest at the beginning of the loan and decreases steadily over time based on the amortization schedule, all right? And escrow, property taxes, and home insurance are gonna go into that account. PMI, if you're required to pay, this will be part of your mortgage payment until you reach that threshold. And then you can talk with your lender about making the PMI go away. All right, the process. First thing you want to do, make sure you get financing before making an offer. Okay, one of the worst things you can do is make an offer on a house, get it accepted, and then financing falls through. It's bad for you, it's bad for the seller. So get financing approved before going looking. Okay. Shop for a house in your budget. Make sure you have a budget. Shop for the house and then make an offer that is accepted by the seller. Third thing, once that offer is accepted, the lender will need to go over everything before providing a final approval. All right. And then once that final approval is given, you're going to close on the loan. Okay. You're going to pay the down payment that day. You're going to pay the closing costs. Okay. That's an additional cost for all the paperwork and legal stuff that has to get done on the loan. You're going to sign all the papers, and then they're going to hand you the keys to the house. So that's how the mortgage process works, all right? So in a quick video, that's pretty much all you need to know about mortgages. Obviously, do your own research when the time comes for you to buy your house.